as we know, stress testing is common in engineering, and in essence, what one does is, in all stress tests, whether it's for financial purposes or engineering purposes, is ask a what-if question. You ask, what is the defined consequences of a specifically defined stress shock, such as will a building collapse if there's a Category 5 hurricane, or will a financial institution collapse if there's a 2008-like change in the market? And financial stress tests can be used to measure solvency risk. They can be used as a component of managing risk appetite by, for example, comparing stress losses at a certain confidence level relative to income. And of course, they also can be used for liquidity risk management. In this presentation, I'm going to be focusing on stress tests as a measure of unexpected loss, which can be used both as a component of economic capital as well as risk appetite. Now, the key thing, let me take a step back and explain how this developed. In December 2007, there was new management at Citi, which was a good thing. And one of the results of the new management was our new chief risk officer asked me and my boss to develop a firm-wide stress test, which I did. We had a lot of back and forth discussion of how we would do that. Within a month, I had the first version of the stress report created, and within a few months, this was being, a component of this was being sent on a regular basis to our board. What we did over the next 18 months, though, was refine the stress test, because in running a firm-wide stress test, a number of interesting methodological issues arose, which were hard to anticipate, but which were resolved over time. And what I'll focus on are what those issues are and why we chose the particular method of resolving the questions that came up. So so with that perspective, to highlight some of the fundamental issues, the first is, what is the definition of a stress loss? Now, when we first created the stress test, at the request of the CRO, we looked at everything from a fair value perspective or a mark-to-market perspective. When I mean everything, I mean everything. Every portfolio in the firm, wholesale, retail, accrual risk, or mark-to-market risk. But my boss and I stated right from the start that we didn't think this was an appropriate way to look at the risk of the accrual portfolio, and over time we developed very strong arguments for why that was so. In other words, arguments against a fair value approach for the banking book. I'll explain why. So we ended up concluding, and then I'll explain the reasons for this, that there were two perspectives for doing stress measures, two perspectives for measuring change in value. One is we called internally price risk. It's just essentially market risk perspective. Loss is defined as the change in the actual mark-to-market value or the imputed mark-to-market value of a portfolio. And obviously, to measure the potential change in value from this perspective, one would stipulate changes in market variables that drive value. So this type of change would be specified by changes in level and shape of the yield curve, changes in spreads, equity, commodity prices, implied vols, etc. But a separate and different perspective for credit risk was a value risk perspective. And here, we define loss most broadly as the unexpected lifetime loss due to default of a portfolio. And then this can be decomposed into the unexpected loss over the first year, plus the unexpected loss over the remaining lifetime, but the unexpected loss over the remaining lifetime is equivalent to the change in the unexpected change in loan loss reserve at the end of the first year. Now you might say, well, if markets are efficient, won't these two perspectives be the same? And the answer is yes, if markets were efficient, but as I hope you could take, one of the important things to take away from Ben's talk is that in a crisis when liquidity risk and funding, the liquidity trading risk and liquidity funding risk dominate prices, there can be an enormous difference between the price risk and value risk perspective Meaning even if you calculated or stressed assumptions, what the cumulative lifetime default loss of a portfolio is, you can come up with a very different answer than what the stressed market value is. We literally saw that by running those sorts of tests. So we've concluded, I'll explain what the conclusions are in a second. Another issue is, how do you define a stress scenario? We defined two forms. One is systemic stress scenarios, which we use for measuring potential firm-wide losses. And one of the simplicities of this is that when you look at stress events, you can make simple correlation assumptions, such as in a real severe stress scenario, all energy prices, just as an example, will increase 50%, or all credit spreads will double. In addition to systemic stress scenarios, there are business-specific stress scenarios, which essentially focus on basis risk within the business, capturing risk of relative value positions. And these are complementary ways of doing stress scenarios. One is focused on individual portfolios, the other is more appropriate for firm-wide losses. There's also a difference in how you derive the stress scenario. We created two methods. One was stylized historic scenarios, and I'll explain how we specified them. We also worked internally with an economist to create conditional hypothetical scenarios. What I mean by conditional is conditional on the current state of the economy. What are, at a certain confidence level, like 1 chance out of 10, some of the bad things that can happen over the next year? And that will change over time. Whereas the stylized historic scenarios are going to remain constant. They will be what can really happen, under bad conditions, and you'll see what those bad conditions are. In interest of time, I'm going to skip this next section, except to say that we realized too that we have 3 categories of portfolios. One we designated as market risk. This would be the traditional trading portfolio, the unilateral CVA, any retail macro hedges, which, because there wasn't perfect correlation between the hedges and the underlying accrual losses, we just separately treated as market risk. Then there's the standard deposit loan portfolios, both wholesale and retail. But there's a third class of accounting that banks have that are subject to what are called other comprehensive income. And the most familiar type are AFS portfolios, but for a firm like Citi, where we have businesses in over 100 countries, in every country we will have either a subsidiary or a branch that will have local currency denominated assets, liabilities, and equity. And one of the risks we have is, of course, that if local currencies fall relative to the dollar, then the local currency equity we have in every one of those branches or subs can fall. But the decrease in that local currency equity doesn't show up as income, even though it does decrease firm-wide equity. It's an example of what's called other comprehensive income. Under Basel, Basel pre-2009, the right 2 columns would be called the traditional banking book, the left the trading book. And in a traditional banking book, the primary ways of dividing up risk are credit risk and the interest rate risk in the deposit loan portfolio. All of that was relevant for how we structured the report, but ultimately what mattered, as you'll see, is how we categorize all of these portfolios as being subject to price risk or value risk. Let me skip the section explaining OCI. You can read that in the when this is available. Now let me go into details in the methodological issues. The first one is this very fundamental question of what is the appropriate way to treat accrual portfolios. Now, there's a lot of arguments that have been made over the years for everything should be on fair value, and that the appropriate way of looking at risk is to fair value your accrual portfolios. We concluded that's nonsense, and that even though initially we measured all of these portfolios from a price risk perspective, we realized there was a problem with that. The problem is that if you have a portfolio of loans, for example, this is a key context here. If you have a portfolio of loans and they are being held to maturity, there's no intention to sell them, securitize them, or hedge them, with credit-sensitive instruments like credit default swaps. And if they're funded to maturity, the only risk you have over the life of that portfolio is the cumulative credit losses that you'll have. And the measurement, even under stressed conditions, of the cumulative loss due to default can be very different, we found, from what the stress loss of market value is. This is connected to Ben's presentation, the difference between, he used the term intrinsic value and market value. There's an enormous difference between a large portfolio, what you, even under stress conditions, you can conclude its cumulative default losses are, and what it would have as a loss given stressed market conditions. And the reason for this is market spreads include not only the market's estimation of expected loss, but there's a credit risk premium for uncertainty about default losses, and most importantly, credit spreads include both a funding liquidity risk premium and a trading liquidity risk premium, and as the previous presentation discussed, those last things can become enormous and be the driver of changes in spreads. And they're not at all connected to a measure of expected loss, even expected loss conditional on stress assumptions. And this is not a proof, but this is just an example. This comes from my colleague, Charles Monet. What Charles did here was evaluate credit spreads as predictors of losses to actual loss experience using 2-year spreads as of December 31st, 2008, and compared that to actual default losses through December 31st, 2010. Now, he obviously didn't go into a time machine, so how does he know what the cumulative losses will be through 2010? Well, he knew what the losses were in 2009 from Moody's data, and then he used two things. One was Moody's estimate of what losses would be in 2010, and then the second approach was to assume the worst case, and that losses in 2010 would be identical to what they were in 2009, which was a very severe year. The result is the following. The top shows, and apologies, I borrowed this and I should have reformatted it, because the top section is expressed in percent, the bottom section in basis points. So there are these two estimates of default loss. One saying, given what actually occurred in 2009 and Moody's estimate for 2010, versus essentially assuming that in each year the losses of 2009 repeated itself, compared to the 2-year spreads of both bonds and credit default swaps as of December 31st, 2008. And then in the blue middle sections are the ratios. So you can see that for bond defaults, the market spread divided by the Moody's estimate of what the actual losses will be for double or triple A was a ratio of almost 800 to 1, and for CDS spreads, almost 253 to 1. Now, there's several things to note. One is if you just compare the ratio of bond spreads to CDS spreads, or the difference between bond spreads to CDS spreads, there's an enormous difference between them. And the question is why? If they're both were estimates of expected loss, they should be identical, and they're enormously different. The difference varies between 300 and 600 basis points. We think that's just evidence of funding liquidity risk. Bonds have to be funded, CDS is dumb. And when markets become very illiquid, one of the components, one of the drivers of bond spreads is not only the current cost of funding the bond, but the uncertainty of what that cost might be going forward. So there was an enormous difference between bond spreads and CDS spreads, which in itself shows that spreads can't just be a pure estimation of default losses. And then there's a very big difference between what the spreads were and the actual loss in 2009, the expected loss in 2010, or just the actual loss in 2009 doubled. Now, this is only one example. You could argue that, well, the market was rational in December 31st. It didn't know the subsequent government intervention, et cetera, so one example isn't going to prove the point. But I think historically, others have looked at this, and I believe, almost always the case that realized losses are much lower than was implied by spreads. It's also what I'm presenting here as an argument is consistent with the point that Ben made in his talk about what is driving spreads in a crisis. So this was an argument for why we should not use a market risk perspective for portfolios that are going to be held to maturity and funded long term. So in principle, we said we would divide the accrual portfolio into two parts. One part would be subject to a price risk, and that would be if it failed the criteria for value risk. For example, if it was going to be hedged or securitized or sold versus it met the criteria. Now, as a first step for simplicity, since almost all of the accrual portfolio, in fact, met that criteria, in conducting the stress test first cut, we just assumed everything was value risk, and later we'll divide the part of it that's subject to price risk to a market risk stress scenario. So in conclusion, we ended up saying everything is price risk except the accrual portfolio, and interestingly, some of the available for sale portfolio. When we looked at the available for sale portfolio, it was, in a certain sense, a mess, because there were very different strategies for different parts, different available for sale portfolios around the firm. Some are investments in sovereign debt in countries where they have to have those positions. They're not going to be sold. They're very long-term investments, and they behave more like value risk than price risk. And on the other extreme, there are available for sale portfolio of bonds that very much are managed like trading portfolios. So the conclusion we reached is we really needed to look at the details of how the available for sale portfolios were managed in order to decide what the appropriate way of measuring their risk was. Okay. How did we measure stress changes? How did we define the stress scenario for bond spreads? Well, initially, what we did this for each month of 2008, we said, we did the following. We said, we have a baseline set of spreads. Let's say initially 130 spreads defined by rating and by currency and asset class. And for each of those spreads, we defined the change in spread by specifying in our stress scenario a percentage change. Let's say 100% widening of spread. So 100% widening to whatever the baseline was. Initially, the baseline was simply the month-end spread by asset type, rating, and currency. This created an unexpected problem. During 2008, spreads got wider and wider. And then, after March, when bear went, they got very high, then they came back some, and then they got high again. And what ended up happening is, in the stress report that I was creating, what was dominating the change in stress loss month by month was simply the change in baseline spreads. As month-end spreads were so volatile that we had essentially an elastic yardstick. So stipulating this stress shock is 100% widening of whatever the current spread is meant every month we were applying a different magnitude shock, and that difference in magnitude was completely dominating the change in losses. And it ended up being a useless report for senior management because they couldn't tell, is the desk taking more or less risk, or are all the changes in the stress losses simply the consequence of baseline spreads changing. Second, we realized it was a pro-cyclical measure. What that means is, in good times, let's say if a triple B spread was 20 basis points, then doubling it is a 20 basis point shock. If in a crisis that is 3 triple B spreads or 300 basis points, the same stress scenario would mean a 300 basis point shock and much larger loss. So it resulted in a pro-cyclical measure and also a volatile measure. And we realized both were a problem. And we looked at 3 alternatives. Leave it alone, keep it as a pro-cyclical measure. Second was to develop an anti-cyclical measure, i.e., assume we knew how wide spreads could be, and then measure the distance from that maximum value to where current spreads are, and that tells us how much credits could change, how much spreads could change. And the third was a steady state. Now, we ruled out pro-cyclical because it was creating a lot of problems. We ruled out anti-cyclical because one of the things we realized during 2008, we had no idea in hell how wide spreads could get. And also we thought it would be pretty bad for our CEO or CFO to be standing in front of analysts and saying, well, we lost a ton of money this quarter, but the good news is spreads cannot get wider anymore. And so our losses have ended. That just was not a sensible thing. So what we ended up with is a steady state definition. And what we did is we said, let's fix the baseline so that 100% of the baseline, i.e. the baseline is the stress changes for every one of these categories that we observed in 2008. And so we defined 130 generic spreads by currency, asset type, and rating. And then we've made further enhancements to integrate systemic default losses into these spread changes so that our shocks include both changes in spread and incremental default loss. And this is something we're still refining as we get more data. Now, just to give you a sense of what this means, we look back in doing all of the work on creating stress scenarios to over 90 years of data. So, for example, we got spread data back to 1925. Here's 84 years of spread data, AAA in blue and BBB in maroon. And this is just the level of spreads. So you can see, for one thing, the level of spreads by the end of in February 2009, was approaching the level of what occurred in around 1933, I think it was. But more interestingly, if you just now transform this into the annual change, change in spread, looking at 2 dates, 1 year apart, here's the BBB series, and quite amazingly, what occurred in the crisis was virtually identical to what occurred at the worst part of the Great Depression. The change in the BBB spread replicated what happened to the change in the BBB spread. I think that was in 1932. And one of the things we concluded is this change wasn't some 1 in 1,000 year event. This was a 1 in 50 year event. Remember, we're supposed to be measuring, and we'll come to economic capital in a second, we're supposed to be measuring economic capital for Basel purposes at the 99.9% confidence level, internal purposes at 99.97. So this change in spread wasn't some 1 in 1,000 or 1 in 1,000,000 year event. This was a 1 in 50 event. It's happened twice in the last 80 years. Now, I think the funny thing is, when we began developing the stress test in December 2007, someone said, well, shouldn't we look back at what happened during the Great Depression? And unfortunately, I was one of the persons in December 2007 and said, that can't happen again. But, so, lessons learned. What can happen again? Now, this ties into the next topic, is how do you define a stress scenario? When the very first thing I did in December 2007 is, I used recent history. So I said, well, what are stress scenarios? The 87 crash, the LTCM Russia crisis. We had only 1/4 of the subprime crisis available in December 2007. And then, conditional on where we were then, the economist was working with said, well, here are 3 macroeconomic stresses. We could have stagflation, deflation, overheating. Each of these were defined by literally projecting states of the economy out over time. We measured a 1-year loss. Now notice the problem, there's enormous differences in the time intervals of each of these events. And second, there's no even attempt to assign a likelihood, a frequency of this occurring. So again, we went back to history and we ended up with 2 historical scenarios. And we came up with them in the following. We looked at 90 years of history and we said, the obvious thing is whenever you look back, virtually every financial crisis has credit spreads widening and equity prices falling. That's almost a no-brainer. But in some crises, like occurred in 2008, you see interest rates energy and commodity prices declining as spreads widening. Essentially, they're deflationary type crises. And the best recent example was 2008. In contrast, there are other crises like occurred in '74, where while spreads were widening and equity prices were falling, the level of interest rates, commodity and equity prices all increased. That was an inflationary stress crisis. So we ended up concluding these were complementary stress crises. The thing all of the stress crises had in common were spreads widening and equity prices falling, but these two had orthogonal behavior of the other sets of important asset classes. And so we defined two large systemic shocks, 74-like event and a 2008 event. And we concluded they both were roughly 1 in 50. And you'll see why coming up with a 1 in 50 was important, because we want to link this ultimately to an estimate of economic capital. These are obviously real rough estimates, but we realized 1 in 50 was a more appropriate number than 1 in 1,000. And then, again, this was the initial set of 3 hypothetical scenarios defined by an economist, and they were getting updated once a year. The beauty of this, all of them were over 1 year, and each of them could be assigned a rough estimate, a rough probability. And by 1 year, we're obviously making assumptions of illiquidity. We're assuming initially that everything was illiquid, so that we were asking, given how wide spreads could change in a year, and given fixed income positions, how much could they lose? Later, this will have to get refined to if there's really evidence of, dollar-euro staying liquid, you don't want to assume FX traders could do nothing for a whole year as foreign exchange rates changed. And so these stress reports were used as a component of weekly ICG is institutional customer group. It's our sector, wholesale sector. So there's 2 weekly ICG risk committee meetings, and they get a weekly, thick weekly risk report, and one component of it looks at stress, makes use of the stress report and changes in the stress report. The stress sections of the stress report go to both the Citigroup and Citibank board of directors. They go to regulators. They help define our stress, loss, and risk appetite. And now the next topic, they're a component of how we calculate economic capital for market risk. And this was, in a sense, exactly the same kind of observations Ben made. We realized in a stress crisis, the kind of diffusion assumptions you use in measuring VAR weren't applicable. You get changes in step-like changes in volatility and correlations that are extremely difficult to model with VAR. So what we concluded we needed to do was integrate stress scenarios into the VAR process. Now, very quickly, we for a long time have measured economic capital over a 1-year horizon as unexpected losses over 1 year at the 99.97% confidence level. A few other key features is we've always defined economic capital assuming the businesses are operating as a going concern, and that has several consequences. That's why we think it's appropriate not to use a market risk perspective for accrual portfolios, because we're not going to liquidate them. If we were shutting the firm down and everything was being liquidated, then a mark-to-market perspective is appropriate for everything. But if you're holding assets to maturity and have funded them to maturity, we don't think that that mark-to-market perspective is appropriate for accrual portfolios that meet that criteria. But also it means that for the trading business, unlike other firms, we've never assumed we can close down all our risk-taking in a month. And so we've never defined economic capital as, well, how much could we lose over a month or a quarter because, well, we just won't take any more risk after that. We're a trading business. We have customers who will be taking risk continuously as just inherent part of an subject to Senate approval as part of an ongoing business. And we also needed to calculate full tail risk. So my colleagues, Ed Warwick, former colleague Ed Warwick, he's now at Nomura, and colleagues Alan Smiley and Charles May were the developers of this approach for enhancing how we calculate economic capital for market risk. there are three components: VAR, systemic stress tests, and, as I mentioned earlier, business-specific stress tests. So you can think of it really simplistically as partly as a jump diffusion model. Assume, for various reasons I won't go into, that 90% of the simulations will be pure VAR, or in a diffusion state, and then 10% will be in a stress state, and that was one of the benefits of defining these rough probabilities, like 1 in 50 or 1 in 10. We could then divide up the stress scenarios into what fraction of them we would be in each one of these stress states. Now you might think, oh, well, you're just simply adding VAR and a stress test. Well, it's more complicated than that, more subtle. So let's assume we did a VAR simulation, and this was our distribution of outcomes. Let's just assume this is a normal distribution. And let's assume if we did 5, 2 historic, 3 hypothetical, we get 5 outcomes, ranging from, let's just hypothesize, gains or losses, depending on the composition of the portfolio relative to the scenarios. Now, what we did next, this is the real insight Eduardo, Allen, and Charles had, was not simply combine them, but to take the 5 stress scenarios and use them as the 0 point of the VAR simulation. So for each one of those stress scenarios, we then ran VAR, where instead of the assumption being the change is, normally when you run VAR, you assume on average your portfolio won't change in value, and you have a distribution around that. But here what we did is we assumed we jumped to a stress state, and then there's, initially they used the word fussification. We're a little bit uncertain exactly what stress state we're in, so we're going to jump to the stress state, as defined by changes in market rates, and then we're going to superimpose on that the variability of VAR. So we end up with a VAR type, operational risk, a VAR type of distribution, and then 5 little distributions around each of the scenarios, and the result is a very fat tail distribution. And for the trading book as a whole, or the firm as a whole, what ends up dominating the potential loss is the stress scenarios. But for some particular desks, it's actually the VAR component still dominates, because what happens when you look over many desks, under normal VAR assumptions, you get a lot of diversification benefit, because you're just assuming many market rates are uncorrelated or weakly correlated in VAR. So to really capture the stress losses for the firm as a whole, you need to include these stress scenarios. Now, doing that only tells us actually what the loss might be, 1 chance in 50. To arrive at economic capital, we have to scale that up. And we realize we can't really simulate realistically what can happen 3 chances in 10,000. It's hard enough to even estimate what this 1 in 50 stress loss is. But looking back over the 90 years, and this is obviously very rough, full of approximations, we looked at the change in bond spreads over this roughly 90 years. We saw the distribution. It was approximately fitted by a student key distribution with 5 degrees of freedom. And so using that fitting, we estimated that the 99.97% loss would be roughly twice the loss at the 98th percentile confidence level. And that's how we came up with measuring economic capital as twice the stress loss for the trading portfolio. And we also, also included this, had to scale up VAR to come up with that total distribution of economic capital loss. So the conclusion is we've not only developed a tool that has been used to measure risk, to show the board of directors what the level of risk is, to define risk appetite, but also, very importantly, we've enhanced how we measure economic capital for the trading book to take into account that under stress conditions, both changes in spreads and other market factors and the assumed correlations of those market factors change very, very dramatically, and that they're best captured by this integration of stress testing and VAR. So I think, so in summary, here are all the components that go into the simulation of the distribution of losses in the trading portfolio. That's scaled up to calculate market risk economic capital, and that's one of the components of total economic capital. Interestingly, we reviewed all of our other methodologies, and virtually all of them did reasonably well during the crisis, but the one material thing we had to change was our measurement of economic capital for the trading book. There was some tinkering with methodologies for the other risk types, but like wholesale credit was very good, but it was market risk economic capital that required the most tinkering. That's it. We're open for questions if there are any. Are there any? Yes, Brian.
I think I'm gonna put this on. For everybody's disclosure, I'm with the Federal Reserve, so this is a regulator question. And I'll state it as a statement rather than a question, because I don't want to put Ben on the spot. One of the key assumptions you made in there in your slide, you said it a couple of times, but it kept sneaking out, was for the accrual portfolio, if these things are funded to maturity.
Yes.
And one of Ben's slides was, don't underestimate complexity and opacity, that they matter. Banks are the ultimate complex and opaque entity. And so I guess the statement I would make, or the question I would put to you is, how can you assume that you will be able to hold those things to maturity in the presence of maturity transformation, where a large portion of your balance sheet is short funded, and essentially you face the run risk of people saying you're opaque, I don't know what you've got, why shouldn't I expect you to stress that further in a market value context because of that?
It's an excellent question, and the answer I give, I think I need to give more thought to, but what we did conclude is we had sufficient long-term funding to say, let's say the entire accrual portfolio there was sufficient long-term funding that was equal or greater than the assets in the accrual portfolio. So therefore that we could say that that was boxed off and did have matched funding. Now, that doesn't mean that there's not a maturity transformation and that some of the treasurers earn an interest rate spread between short-term funding and the funding of their assets. But for the firm as a whole, we were convinced we had sufficient long-term funding that we could put against the accrual portfolio to say that they can be boxed off and we wouldn't be forced to liquidate that. That was the answer that that senior management came up with. So we did look at the total amount of very long-term funding and the total amount of the accrual portfolio to at least ask the question, is that ratio great of funding to assets greater than 1, so that we could say, yes, we can box that off. We're not going to be forced to sell those loans. But it's a very good question.
And my question is just, I don't know that the market can see through to that, and so you still ultimately face the run risk of people making the decision that the ultimate realization of the losses on the portfolio will be such that you're insolvent at the maturity of their funding, and so they run.
And this then goes back to, how do you prove to the market that you have sufficient liquidity in place and sufficient capital? Part of the problem is avoiding a self-fulfilling prophecy, because if the market thinks you're illiquid and not sufficiently capitalized, can they force you to liquidate assets that you didn't want to? So that's why we said, well, if we have the long-term funding in place, then we literally can box this off and say it's not subject to market risk, that yes, the market may not divide Citi into separate boxes, but there would be other assets we would be forced to sell, not the accrual assets. let me get back to you with, with further thought on that. There was another question, Martin?
Yeah, for Ben, you had said 10 years ago that when times are good, risk management fades into obscurity. Obviously, that's not the case right now. How long do you, what sort of signal will the economy give that the customers will start to forget and risk management will slip back into obscurity?
Well, I think we were getting a little bit nervous for a couple of months. You started to hear, for me, the word is, insurance companies need yield. And when you hear that, that's a sort of a signal that, the greed element is beginning to take over the fear element in the marketplace. I don't, certainly spreads did not get to levels that were looking, exceedingly rich, but they were beginning to, make you do a little bit of arithmetic.
Just anecdotally, I was at the Fed had something called the Fed Forum 3 or 4 weeks ago to discuss Basel III, and had a number of panels. And one of the panels discussed a component of the Basel III proposal, anti-cyclical buffer. And I asked the panelists a question about, given our experience with stress tests, we defined this steady state shock that removed the cyclicality of the risk measure. Why couldn't that be a better approach than requiring a buffer? An interesting answer, I won't give names, but one of the panelists, who's either the chief risk officer or a very senior person at a large bank, said that it's really hard to get the business to accept over long term that their risk will be measured by severe stress scenarios. And he said he's already getting pushback from the business when he applies a 2008 stress scenario. He's now being told by the business, that can never happen. So how quickly they forget. Yes?
Some of the points you made on your slide mentioned the efficient market hypothesis or efficient market assumption. Under the current environment of the crisis, the efficient market hypothesis or the rational expectations theory has been challenged, as you probably heard. And this second school of thought is that the market is dominated by human psychology or human behavior, such as fear and greed and overconfidence, mental framing, and so forth. So, what is your? I would like to know what is your take on this second thought of?
I think that the term is animal spirits.
Animal spirits is led by Robert Shiller. Whether the question is whether you can incorporate the human factors in your model, possibly, and if so, what would be your approach?
Well, I'm not sure I'm prepared to throw everything out the window, but I think what's missing from sort of the theory that I was schooled in was there was implicitly a notion that you had a market with a infinite number of small players, and those players sort of acted independently of each other.
Right.
So, if you cut through all the fancy math, it was basically an implication that, again, these sort of independent atoms were all interacting in the market. And what is clear is that that theory misses the interconnectivity between all the players. So I guess my predilection would be to envision that you have to develop something where, imagine this gigantic matrix of different, stochastic differential equations, which were describing the fact that the impact of one financial player on another and another has many, many consequences. So I think a model like that would admit to a lot more of the instabilities that we see. So, you know, so I'm not saying that there's nothing to the fact that people sometimes will do what they'll do, and you know, when you actually experience it firsthand and you can see the fear, and you can see people, you know, literally deer in the headlights, and you know, I read about that I actually lived it when I saw it. So yeah, I can't totally dismiss that as being part of the empirical reality, but I think you can probably, you know, if I were offering grants to research institutions, I would suggest that they would focus their efforts on trying to understand the implications of connectivity of financial institutions. So, take one more point. If you think about, let's say, the structured finance vehicles, in this case, you have actually financial robots that exist, and you know, so if you were involved in the market, let's say with leveraged loans, you saw that there were CLO after CLO, and they hit a limit. It was a program. The program said that if you hit this limit, you have to liquidate. A trustee who had no discretion went ahead and did a liquidation, dumped all the assets onto the market. The market fell down. That drove the market further, and you sort of had these cascading effects, which was sort of part of the structure of the market. And there was no psychology. It was just sort of following the rule. Arguably, some of the trading rules,
So you can't.
variations of portfolio insurance type things. When these things are programmed into the system will behave a certain way, and so I don't think it's all psychology.
Of course not. Well, on the other hand, it's not all efficient market either. So, during the past decades, this theory had dominated the policies and the markets. And right now, into the current environment, whether it's regulatory, technology, advancement, and so forth, we see a lot of human factors. Or if you give more freedom, or if you're deregulated, people have more freedom to do whatever they want to do. So
I wouldn't confuse sort of human behavior and whether or not markets need regulation.
In the back?
Thank you very much. So, Mr. Picol, your question, excuse me.
Is there a mic, there's a button by your mic, maybe you see.
So you're mentioning that you're dealing with agency complications, i.e. the business is reluctant to work with you to get its arms around the business?
No, I just said that another firm, someone was
Oh,
reporting
understood,
that.
okay. So I have several questions, because my concern is because I admitted counterparty credit risk at one of the world's largest banks and handled their financial institutions, but those smaller names. So, given the interrelationships and, of course, the exposures that the large financial institutions have with each other, I mean, I'm hearing, and pardon me, but my read on this is, we're looking again at the too big to fail. You know, that the interrelationships aren't where the banks themselves haven't probably, because my concern too is where with a lot of the over-the-counter derivatives trading, the lack of cash flows with those instruments, the parasitic nature of the cash flows that the enterprises are encountering. You know, if you don't have moving markets, all of a sudden, because the banks haven't properly factored in the over-the-counter derivatives trading into the overall risk exposures.
That's what you're saying is true. Banks have been very focused on measuring counterparty credit risk, and in fact, virtually all interbank transactions are margined. So banks have they're also netting rules and legally enforceable netting and margin rules in effect in the interbank market. So although the volume of derivatives in the interbank market is huge, the residual risk is much, much smaller than that, precisely because so much attention has been focused on making sure that risk is being properly measured and managed and mitigated. So that there's no ticking time bomb or any such thing as that.
So there's more caution now than there had been?
There has been question for a very long while. This didn't spring up suddenly. Banks have been entering into, there's an organization called ISDA, which has been very focused on, its reason for being was creating standardized contracts and including contracts that had legally enforceable netting and margin agreements. They've worked with legislatures around the world to make sure that those agreements would be legally enforceable. So there's an awful lot of effort been spent over many years in the market to make sure that counterparty credit risk is being measured correctly and is being mitigated simply because of the growth of the volume forcing every bank to do that.
But what about the exposures contingently with regard to these instruments? And then, my next concern is the, while banks are adequately capitalized to deal with their commercial banking activity, the additional necessity for capital and sufficient collateral or liquidity behind these instruments is insufficient. So, excuse me if I'm...
Banks, rather than AIG, which was an insurance company, I don't think knew what it was doing, but banks have both internally developed very strong economic capital models, and they've been required by regulation to measure both the counterparty exposure and the economic capital associated with counterparty credit risk, as well as there's regulatory capital attributed to it. So a lot of the scare stories in the newspaper that this was an unregulated market was nonsense. There were all sorts of requirements that banks hold capital, that they measure the risk, their exposure, and that they hold capital against it, and there's been lots of refinements in how that is measured. So as you've been asking questions, you've been taking notes. I hope you realize that this...
No, I'm an analyst, because
okay.
yeah,
I thought
I've
you
been
were not a
following...
reporter.
No, well, you never know whose senator's attention it may get to. But, because $16 trillion of voters' money, through one mechanism or another, and it's not just TARP. Whether it's the Fed discount window or whether it's some other kind of, sluice of liquidity that's been provided, to keep the markets floating and moving, and so the banks can engage in these activities. And it doesn't. It's not a big. That's a huge number. And this doesn't sound.
What does this have to do with derivatives?
Well, it has a lot in part because, again, that a lot of these instruments don't have cash flows themselves, or only at the triggering event, and then the barter aspect of the trading activity, which engages, or let's just say, the parasitic nature of the lack of cash flows.
I don't know. I think if we're around, you can ask us questions after, but I don't understand a lot of what you're saying. If you've actually studied, there's an awful lot of work that's been done in measuring the value, the cash, based on the present value of the future cash flows of derivatives, and also measuring counterparty exposure on a portfolio basis, and measuring methods for measuring economic capital for counterparty exposure. And an awful lot of work, legal work, has been done on ensuring there are legally enforceable netting and margin agreements. So the actual world is very different from some of your assumptions in your questions. But maybe we have one more question in the back.
How do you model the interaction between different types of risks, credit, market, operational?
That's a challenge. And if you're doing it for the firm as a whole, there's two ways of doing it. One way would be the ideal way that I don't think any firm has the ability, and that would be you build a super simulation model that would say conditional on different macroeconomic variables and changes in market rates. Here's how conditional on that, all of our risk. It's easy to do that in a stress test, because in a stress test you can simply stipulate, here's a stress scenario, here's a state of change in macroeconomic variables, here's a change in market rates. Given this stipulated condition, what would our losses be either for trading or credit? But in real simulation, that's very difficult to do, and it's also very difficult to integrate operational risk, country political risk, and various other risks. So the ideal would be, you you win a Nobel Prize, create this incredible macroeconomic model that can do all of that. What you often and realistically have to fall back on are correlation assumptions between the different risk types, and then those correlations can change, depending on whether you're in a stress condition or not. So you look at a lot of history, and you look at the relationship. Like certainly we know that in a stress crisis, credit deteriorates, credit spreads widen, equity prices fall, and then, as I said, there are these complementary scenarios of deflation or inflation. But how it actually affects losses or gains depends on positions. So you have to look at history and validate reasonable correlation assumptions.
I mean, you can create the sort of false precision of some of the, try to do it all mathematically, but I mean, certainly, at least, what I see on the operational risk events occur, and I guess if you, let your company, make massive errors so that you can sort of see what that looks like, and, sort of run that, create a good data set, but most people try to avoid that, and I mean, there are, regulatory requirements, even for an asset management firm, and we have to estimate our operational risk. But ultimately, it really comes down to just trying to define some plausible scenarios, some plausible probability, and being in a position to defend that. We have a discussion with the regulator is plausible because you don't know.
One comment, we did look at history, and one of the interesting things we saw was a high correlation between operational risk and credit cycle. What would one have to do with the other? Well, if you remember that one important component of operational risk is legal risk, getting sued. Investors tend not to sue a firm when they're making money. So when the market is rising and credit spreads are falling, and everyone who buys bonds or equities from the firm and who owns stock is doing great, you tend not to get a lot of suits. But when the market turns, then, especially in a litigious society, suits rise. And it also goes back to something Warren Buffett said about the recent huge fraud. It was the Madoff. That he said something like, when the tide goes out, it's only when the tide goes out that you discover who isn't wearing a bathing suit. And so problems sometimes only surface when markets turn, and then you discover that customers are unhappy and you might be subject to suits. So there is some correlation between operational risk and credit losses as a consequence. With that happy note, we'll thank you for.
Risk management that didn't disparage reliance on, or excess reliance on models being complete. And I can tell you that Google Maps on the BlackBerry is not nearly as good as I think it should be. But we'll try to go into some of the other lessons, perhaps in a more structured way. But it's a pleasure to be here, and I guess I'll speak, Ed will speak, and then we'll have some time for questions. I've given this presentation a number of times over the past couple of months, and I've been, depending upon what was going on in the market, somewhat in apologetic mode, meaning why would we ever want to talk about a financial crisis that was a historical artifact? The markets are booming. And I would then try to make some presentation about why, even though it was a historical artifact, it could be relevant. Then, of course, the markets do what the markets do, and perhaps, that window of opportunity when people actually are interested in risk management has opened yet again. So this is a quote from a paper, actually a book that I wrote. It came out in 2000, and the point was to more or less show the correlation between interest in risk management and financial turbulence. And then, of course, when things calm down, you write books and do things like that. And part of my tardiness is related to the fact that maybe this isn't the best time to be giving risk management speeches when you're actually in the business of trying to manage risk. So if I were telling the story in terms of trying to motivate you, I would say, well, look, the markets have been turbulent, and all the excitement of 2007, 2008 have more or less reversed themselves. So what are we worried about? Now, it's interesting which columns are not on this page, which I guess speaks to the fact that, of course, certain markets have obviously been very, very, very turbulent as of late. We can look at other elements of normal behavior, and again, part of the theme of why should you care? But I'll assume that for those of you who are paying attention to the markets, you kind of know why we should try to learn some things from that. I think in the interest of time, I'm just going to go and discuss, sort of some specific issues that, were lessons that I took away from the crisis. And I guess now I'm speaking historically, but perhaps it may have some relevance for what we see today. And it's the issue of liquidity. And, we'll talk about liquidity in a bunch of different ways. But, even as we think about what's going on now, while we haven't had massive breakdowns in liquidity, like we saw, let's say 2 years ago, it is getting a little sketchy in some markets, and makes you wonder. So, what I call the paramount importance of liquidity is again the realization that if you don't have cash, you can't get anything done. Probably about 2.5 years ago, I was sort of stressing out and needed to get a sugar fix. And I went to the candy machine and wanted to get my payday bar. I had a lot of cash in my wallet that day, but it turns out I didn't have a single. And I'm looking at the payday bar, I'm looking at my wallet, and I'm saying this is exactly what the lack of liquidity can mean, and that you can't do things even though you may have lots of sort of tangible worth or like intrinsic value. It's this thing which if you don't have it, it's something akin to oxygen, as you notice it in its absence, and that's not very pleasant. So how do you reconcile sort of liquidity in a world where you also understand that markets sometimes function very, very well? So the way that I try to reconcile it is, rather than taking the mindset that liquidity is pervasive and always there, which until 2 years ago I think there was generally a sense that liquidity was increasing, markets were becoming better with more information, with more data, with faster internet connectivity, better computers. That's probably a little bit out of favor now, but the whole notion that markets were getting better would seem to be a secular trend. So now we step back and see that even when you have these highly developed markets with lots of infrastructure and technology, in fact, it doesn't always have to work the way it's supposed to. So the way I would reformulate is saying that don't assume that the price is equal to the intrinsic value unless special conditions hold, like the market is liquid today. And I think a lot of the problems that people have when they have sort of taken it for granted, if you like, the shorthand in the math, that you can always sort of convert wealth into cash, that the market that is that vehicle that lets you do that. And in fact, we've seen firsthand, of course, that is not true. And if you go one step further, if you let an institution become so enmeshed in that notion, then of course you can create tremendous mismatches which can have catastrophic outcomes. In particular, I took away the idea that there's a fellow named Swenson from Yale who's written a couple of books and given many speeches, and was fairly vociferous in advocating that only foolish investors would invest in liquid products. You would never invest in a bond unless you needed to have some treasuries for their perhaps counter-systemic characteristics in them, and that assets like timber and oil wells and private equity were the way to maximize the long-term return. But of course, when you have to pay for the construction on your campus, even if the building is made out of wood, I don't think that one of the ways to do that is by delivering the timber from your forest to meet the bills. And in fact, what you can really rethink that strategy is one which is basically selling liquidity in a very consistent way, and having sort of almost a complete disregard for the sort of a quaint notion of asset liability management. And then when you think about bonds and liquidity, at first, if you're in the bond market, you might think that's a contradiction because bonds oftentimes are not that liquid in terms of how they trade. But I'm not really referring to that aspect of the bond. I'm referring to the fact that a bond does something which most other instruments don't do, which it generates cash, and it generates cash in a generally predictable fashion. So if you think about bonds as an asset, not so much as a slave to an analysis which the only inputs to it are a table of historical returns, there's another attribute that's sort of missing from that return, that R, which is the fact that there's a cash flow certainty attributable to that R, which may not be attributable to other assets. And if you take the view that liquidity isn't always there, that you can't always intermediate the markets, then of course cash flow becomes very, very important. I mean, in fact, in my own experience, at a very, very different scale, my firm manages quite a bit of money markets, and we had all sorts of fairly nice analytics that let us understand how we positioned the funds, their composition, their risk, etc. But when push came to shove, what we realized we didn't actually have in a very convenient way sort of that old-fashioned cash flow diagram that you learned in Finance 101, where we couldn't easily push a button and get the cash flow distribution of all the assets in our money market funds. And yes, I knew the key regulations, but when you're in the business of trying to meet outflows, you need to know exactly what your inflow is on a given day. So even in the micro sense, the presumption of liquidity can be problematic. The third aspect of liquidity I want to talk about is the challenge of complexity and opacity, and how they interact. Now, if you worked, let's say, with structured product, again, I'm conscious of where I'm speaking, but there's this notion that the way to be successful is to have the analytical techniques, to have the models so that you can understand in a deep way the nature of the security, understand its cash flows, and you would not be one of those investors who purport to be sophisticated, but in fact wasn't sophisticated. So lots of effort, time, and money go into having that deep knowledge of those types of products. And in fact, the participants who are better in this space, all things equal, you'd imagine, would be particularly good at that. However, the problem is actually much deeper than not knowing what you own when you have that type of investment. The problem can also be that precisely because it's a complex asset, the number of players in that space who can, if you like, equilibrate the price at a sort of a fair level are the same investors who are likely to be the ones first to be impaired or hurt by a shock to that market. So we saw firsthand that there were very large segments of the marketplace that had tremendous dislocations, and I think it was precisely because many of the players who could have participated because they had built up that expertise and competence were the ones who were either taken out of the markets completely, had lost the credit facilities, who were barely hanging on for dear life, feel like they were totally full on the trade. So what happens in a situation like that? You have the next guy who comes in is the fellow who says, well, that's really complicated, so I'll take that price and I'll divide it in half, and that's probably, I can't lose money that way. So you have that huge gap in the pricing, which is the entrant, if you like, of the, so damn cheap I can't lose type of trader versus that complex, dueling analytic trader. And that's a notion which has been sort of written up in a paper in the limits of arbitrage, 13 years ago. But it's something certainly that we saw come to life. And I, again, sitting in my own seat, I saw situations where there were, analytical people who had tremendous knowledge of the markets, but had no ability to act because they either had no dry powder or they were, barely able to stay solvent. Another aspect of the issue of liquidity arises from the impact of collateralization. And by that, I mean that the traditional risk management approaches that you need to, of course, collateralize your credit exposures so that you don't take the risk of the counterparty failing on you. But generally, unless you're an unusual type of institution, those types of arrangements have to be bilateral, meaning that if you're going to post collateral, if someone's going to post collateral for you, you have to do the same to them. And we saw situations where, certainly some of the clients that we dealt with, where their positions became so illiquid that the risk of having to produce the cash, which was an impossibility, would have been more catastrophic than going naked. The fact that the counterparty may or may not fail against them, or hedges, they lifted hedges because they knew that if they had to post against the hedge, they'd be taken out completely. Which again, to me was a very counterintuitive aspect, but again, it drives home the point that sometimes the liquidity aspect of an exposure can become a dramatically dominant element of it. So the next main point I want to talk about is sort of the issue of securitized products and the importance of understanding the underlying assets in a deep and broad way. And the way I would describe it is that I believe that many of those sophisticated investors I was describing before became perhaps overly reliant on models or overly confident that they could statistically derive the properties of the instruments they're investing in without necessarily being aware of what was going on in the underlying behavior of the asset, and therefore became vulnerable to either data which was in effect corrupt, meaning that it was fraudulent, or data which was materially incomplete. So the fact that you may have a loan-to-value ratio of 80 is interesting, but if there's a second mortgage for 20, that's a very different situation. But if you don't know that there's a second mortgage, you might misinterpret in a material way what happened. So this is an example of just one particular deal in question, but I think the takeaway that from this is that if you're going to be involved in this space, you have to have a much broader pipe, if you like, to what's going on in the underlying asset class. That may mean that instead of thinking that the way to go forward in your analysis is by having, you know, a bigger database and a better statistical model, maybe you actually have to have people who, you know, leave their offices, walk around and actually see the properties, meet the people, be more on the ground, and touch things. Because to some extent, this may be a case where Main Street was smarter than a lot of Wall Street, and they sort of gamed the system. That's not totally it, but I think that's certainly an aspect of it, that there were many investors who became overly reliant upon standardized data sources and things of that sort, and the origination process basically fed into that process things that people wanted to see, and the results, of course, were devastating. The third main lesson is this notion of certification. And by certification, I mean the general process where there's some type of exposure that exists out there, and some entity stands between the investor and that exposure, and in some sense guarantees it. And I think we've learned decisively that, you know, those types of things, particularly when they're you know, in effect leveraged, where you have very high amounts of exposure for capital, you know, are utterly useless in a systemic event. If there's any correlation at all in the underlying behavior, then of course you have nothing. And one of the things which, and I haven't changed these slides on purpose, I left them, you know, from 5 or 6 months ago, is, you know, one of the concerns that it sort of begged the question at the time, but I think it's becoming increasingly clear today, that, you know, one of the ways that we tried to work ourselves out of the crisis was by having the ultimate guarantor step in and guarantee the debt. And across the globe, the different sovereigns did that. And, you know, I made this comment on the slide, again, this is probably 6 or 8 months ago, that the financial system has become totally dependent on the last line of defense, direct government guarantees and recapitalizations. And if that, and the implication is that if that barrier breaks, then of course there's nothing to stabilize the system. And unfortunately, you know, I guess as we speak, there's certainly a tremendous amount of concern that some of those initial attempts to fill in for the guarantees which failed through the governmental guarantees are also becoming very much in question. The fourth point is something which I guess you would know in an intellectual sense, but certainly there's one thing to know intellectually, nothing to sort of experience, which is just a massive degree to which the appetite for risk can change and vary in a particularly short period of time. You know, there are many types of indices that you can create to do this thing. We played around with some of them, and just watching the market appetite for risk change dramatically is very stunning. And if you're, it then follows from that, then if you're going to live in a world where the appetite for risk can change, you need to be very careful that you manage your risk carefully. And this particular slide is showing a fairly straightforward bond portfolio and how its risk fluctuated over time. And this is the same portfolio. It's not, we're saying we're holding the keeping the holdings constant and then looking how the risk fluctuates through time. And I think what's, you know, even more dramatic is if you look at the second chart. This is showing the composition of that risk. And if you look at it carefully, and it's the same portfolio, you can see there's a sliver of purple all the way to the left. That same exposure would have shown up on the risk models of 06 as being almost insignificant if you came across the predominant exposure in the portfolio. So I think it speaks to the need to not let the market determine your level of risk, you need to manage it. Now, that's sometimes easier said than done, because if illiquidity arises, then you can get trapped into positions that there's not much you can do about. And then slide 7, and again, I don't know what happened in the testimony today with the various amendments, but this was written quite a while ago. The increasing importance of what's going on in the political arena, whether it be in Washington, London, in Brussels, seem to be increasingly dominating the sources of risk that govern what goes on in portfolios, and so much so that you might begin to think about how you would staff a risk management department, and whether you need to have statisticians or whether you need to have political scientists. And I know, in terms of how you respond to things of this sort, our firm never had anyone involved in that ever. All of a sudden we're realizing that we've got to have folks paying attention to Washington as much as they're paying attention to the screens, because so much of what goes on and affects the portfolios is driven from there. But I think the final point I'd make is you can't cram for a crisis. There are those who will argue that risk management is a futile effort, or it's a charade by charlatans who are pretending that they can somehow forecast the future of distributions or returns and things of that sort. Maybe yes, maybe no, but I think it is pretty clear that you can certainly manage the risk by how you mitigate an event. And to the extent that you have the infrastructure, and you have the resources, and you have the subject matter expertise available, when things occur that you could never have imagined to have occurred, you have the ability to respond decisively. And there I can say, with things I've seen with my own eyes, that certainly if you can figure out how to clean up a mess faster than the next guy, you and your clients will of course be much better off. So I don't actually subscribe to the theory that everything that risk managers do on a proactive basis have no value, but I certainly know for sure that the ability to make a difference when the market is great, can be rather dramatic. So I think with that, I'll turn it over to Ed, and then I think if there's time we can